Meanwhile, of course, while all that was going on, the Treasury Secretary of the United States was meeting with top officials in Beijing, aiming to find some sort of common ground between the two superpowers.
I've made clear that the United States does not seek a wholesale separation of our economies. We seek to diversify and not to decouple. A decoupling of the world's two largest economies would be destabilizing for the global economy, and it would be virtually impossible to undertake.
The U.S. Treasury Secretary in her very measured comments there in Beijing as she continues that trip. Let's go down to Washington, where Kailey Leinz, the co-host of Balance of Power, is standing by. Unfortunately, Kailey, you did not get the trip to Beijing, but I'm sure you were listening in on what Yellen had to say here. What were the takeaways from her first full day there on the ground?
Well, in many senses, Romaine, this is a repeating of the line we've continually heard from the Treasury Department and just the broader Biden administration, that this is about diversification, not decoupling. And the Treasury Secretary went on to say at this meeting with China's Premier Qiang, basically that they are trying to have healthy competition. This isn't a winner-take-all kind of scenario. That said, they are, of course, trying to narrowly target their strategy and in response here to protect U.S. national security interests. But ultimately, Yellen says she wants to keep this conversation going. That conversation today, we understand, according to a Treasury Department readout, did mean she raised some issues of concern. She expressed concern specifically about the metals curbs that China put into place on two very strategically important metals, gallium and germanium, just days before she touched down in Beijing, because, of course, the backdrop to her trip here is this constant tit for tat on trade between these two largest economies. You have the metals moved from China at the same time that the U.S. is looking at restricting cloud computing technology for China, for example. And we know the U.S. have already put export curbs in place on chips and chip manufacturing equipment. And
then there was a report overnight here that U.S. officials have actually sort of renewed or refreshed their auditing inspections of Chinese firms. What's that about?
Well, we know there's been a lot of debate back and forth about the auditing of these big Chinese technology companies, largely that are listed here in the U.S. And there was the threat overhanging for much of last year that they could actually get kicked off of U.S. exchanges. Of course, an auditing agreement ultimately was come to, and that's really what part of this is. We understand, according to Bloomberg's reporting via sources familiar with the matter, that the Public Accounting Oversight Board, Public Company Accounting Oversight Board, did send people to Hong Kong last month to review some of these biggest companies. Think Tencent, Didi, NetEase, all of these at play here, looking at their audits for 2022. And that really just kind of underscores the ongoing tension and trust issues, perhaps, between the U.S. and Beijing.
Well, I have to ask you, though, Kailey, here. I mean, we're on a day where we're seeing some optimism in Chinese ADRs here in the U.S. We also had the report here that there had been a little bit of a pushback against some analysts over at Goldman Sachs who had came out with a recommendation kind of talking down Chinese bank stocks. And this raises a big question for investors is how much freedom and insight do you have to really make objective comments about what's going on in that country?
It really underscores the difficulty for Wall Street banks, for example, on navigating this market. That Goldman note you alluded to came out on Tuesday, basically expressing some hesitation around certain regional bank stocks, and it was actually refuted by a Chinese state-owned newspaper, the Securities Times, that basically said the market shouldn't be taking a bearish view on some of these Chinese banks because of pessimism that is out there, talking about how they've, made attempts to hedge risk when it relates to real estate and property loan risk, for example. So that also kind of puts an emphasis on what seems to be Beijing's concern about market sentiment, as they are dealing with a much more fragile and weaker economy than many had anticipated. Clearly, they are trying to continue support for the markets and not want to feed into any kind of fear that investors may have.